Hello. Hello, hello.
Hi,
Hello.
Kima.
Yes, how are you?
Yeah, I'm fine, thank you. How's things
Good.
with you?
Good. Yes. How are the questions what we have done all this time? You are picking up those things?
Yeah, the questions that we've done have been okay. I
Okay.
did quite a few questions yesterday.
Yeah. I sent you another P&L question. You can go to that one.
Yeah, I'll
And
do that one today and then
yeah, and do
send
it,
that
and
to you
then
later.
we will see how it goes off, and we will discuss it.
Yeah, okay, that's fine.
So today we are going to look at something on the foreign exchange. You know the relevant standard is IAS 21,
Yeah,
all about the foreign exchange. So I'm just quickly going to go to a couple of slides with you, just to refresh your mind on the foreign currency translation before we move into the question, Fiona.
okay.
So we know it's all about IAS 21. That's the standard that we have. So basically, it tries to define two sets of currencies, what we call the functional currency and the presentation currency. It also deals with how to deal with individual transactions in a foreign currency, like if you sell some goods to a customer and you're getting money in foreign currency, how to deal with that kind of a thing. And also it deals with foreign operations, if you have a subsidiary or something like that, how to do the translation on the foreign statements. So basically the most important thing is the functional currency. So basically now if you look at UK, without any doubt, the functional currency of UK is the sterling pound, because that's the currency in which all primary economic activities take place. Right? In Sri Lanka, for us, it's a Sri Lanka rupee. How does this happen? So it's always not always, in most cases it's the local currency. But unfortunately our ACC exam, not fortunately, unfortunately, but most of the time ACC exam puts up in the other way about. In most cases this will be the local currency, but in ACC in most cases it will be something else.
Yes.
We have to be always on the opposite side to the normal natural thing what we see. So whenever we want to decide on the functional currency, there are certain criteria given in IAS 21. Basically, in which currency do we sell? Mainly, main sales. Now, if it's a UK body, most of the sales will be in the sterling. There may be few sales happening in dollars or some other currency, but mainly if the sales prices, the prices are quoted up in sterling, that will be your functional currency. The currency of the country whose competitive forces and regulations mainly determine the sale. So sometimes it's the competitive forces, the others, what do they do, in which currency they do the transaction. And the regulation, the tax authorities, what is the currency that the tax authorities use to calculate the taxes for you. And also the currency in which we mainly, again the mainly, where we pay the labor, material and other costs. Now in our country, for Sri Lanka, for example, most of our transactions are done in Sri Lanka rupees, but we find few expatriates from UK, few expatriates from America, few expatriates from certain other countries working in our country on various projects. For those people, we pay in sterling or in dollars or whatever. So that does not mean our functional currency is dollars. That does not mean our functional currency is sterling. Our functional currency is Lanka rupees. But there are few people to whom we pay. So, but mainly all our labor charges are paid in the local rupees. Almost all our materials are priced in local rupees. So that's the way we will work out and see. So you have to make a kind of a, based on these guidelines, you have to make certain decisions. So there are if you can't, even with these criteria, if you can't arrive at a solution, you go for further factors. The currency in which funding from issues of debt and equity is generated, right? So when you issue equity and loans, in which currency do you get money? Now that again, you might have a situation, bulk of the equity is coming up in UK in sterling pounds. There may be few people, some foreign investors sending the money in dollars. But there again it is the main factor. The bulk of the money has come up in sterling pounds, and therefore the sterling pounds is the functional currency. Currency in which receipts from operating activities are usually retained. The profits, in which currency do you retain after paying the dividends, etc.? What is the currency in profits which you retain? So these are further factors. The entity maintains its day-to-day financial records in its functional currency. Now that's a very important one. The way we keep our records. Now in Sri Lanka, we keep all our records in Sri Lanka rupees. In UK, it will be in the sterling pound. So that's the functional currency. So what is this presentation currency? Presentation currency is another way of saying the reporting currency in which the financial statements are prepared. Right? So you may be a UK company, but you have your parent is in America, and the parent, when it prepares its financial statements, they have to prepare the financial statements in their currency, dollars, and all your subsidiary transactions need to be translated to the presentation currency. So this can be always different from the functional currency, particularly if the entity in question is a foreign known subsidiary. So you are the parent, you are a sterling company, but you have a subsidiary in Sri Lanka. Sri Lanka subsidiary will prepare its statement in Sri Lanka functional currency. But when you want to present the consolidated financial statements, you have to convert the Sri Lanka subsidiary into the UK, and because you're going to prepare it in presentational currency, which is your home currency. In that case, it is your sterling pound. So it may have to present its financial statements in the currency of its parents, even though that it is different to its own functional currency. So translation, we saw some of the questions a little bit earlier, I think last week. Whenever entity enters into a transaction currency other than its functional currency, it must be translated into the currency before it is recorded. So in other words, on the spot date, it must be correctly recorded. So initially it will be recorded by applying the spot exchange rate. So if you sell me some goods today, your invoice is today, today's rate you will convert it, and you will credit sales and debit your receivables. If you are going to send me a Sri Lanka rupee invoice, you will convert it at today's rate between the sterling pound and the Sri Lanka rupee and record it. That's the first thing you will do. That applies whatever the transaction it may be. Ultimately, when the transaction is settled, when the money is paid or settled, again you will use the spot rate and do it, and then any differences arise in between these two, we will credit it to the P&L straight away. The P&L will be credited on the day of the settlement. So it may be say 15th of March that you are going to settle. On that day the P&L will be credited, taken on the spot rate at the day of the transaction, spot rate at the day of the settlement, and difference we will take it to the P&L. But you might find something unsettled. So today you sell me some goods, so we are in February, 31st March is your reporting date, that by 31st March, the reporting date we have not clearly settled yet. So there we have to see what is, you remember we discussed this earlier, monetary assets, monetary liabilities, non-monetary assets, non-monetary liabilities. All monetary assets and monetary liabilities will be converted on the reporting date. Non-monetary assets and non-monetary liabilities will never be converted on the reporting date. So monetary items, I have just put up the example, but they are the only ones. Cash, receivables, payables, and loans. Cash, receivables, payables, and loans. Monetary items, at the take the closing rate on the day of the reporting, 31st March, converting, any difference arising must be taken into the P&L. So remember, it's not yet settled. It's not yet realized, but still we take it to the P&L. So there was, I remember I sent you a little bit of a note about the what is appearing in the other comprehensive income and what is appearing in the main P&L. There was a kind of a misconception thinking, always saying that what is appearing in the other comprehensive income is unrealized income, which is not so. In that article, it was very clearly made, it is not so. And what is reflected in the P&L is realized. Now you can see here it's still unrealized, but we take it into the P&L. We take it into the P&L. So this is IAS 21 treatment. So that comprehensive income statement, it depends on the each different standards. IAS 16 standard says a certain method. IAS 21 says a certain method. IAS 939 says, so different standards will say what should go to the OCI, what should go to the P&L.
Yeah.
Non-monetary items like non-current assets, inventory, investments, all those things we don't translate, we just leave it at the historic rate or the spot rate, but we converted, we will leave it as it is. We don't do any conversion. So this is just a very simple slides thing, just for you to get a kind of a refreshment for yourself. I'll share these slides with you. Now let's look at the question what we are going to look at. This was a 25-mark question, but fairly couple of things. Here we have Aspire, a public limited company, operates many of its activities. The directors have asked for advice on the correct accounting treatment of several aspects of Aspire's overseas operations. Aspire's functional currency is of the dollar. So we have been given the parent company or the Aspire company functional currency is the dollar. That means we know their main activities, everything happens in dollar. Now here, the first part is they have created a new subsidiary. Now I want you to understand the word created, right? It's a kind of a very specific kind of a thing when you create something. It's not incorporate in a company or something like it's a creation which is incorporated in the same country as Aspire. So Aspire's functional currency is dollars, but they are forming up another company, a subsidiary in the same country. The subsidiary has issued 2 million dinars of equity capital to Aspire. The subsidiary has issued 2 million dinars of equity capital to Aspire, which paid for these shares in dinar. So the subsidiary company has issued shares and the parent company has bought shares, although the parent company's functional currency is dollar and in the same country, but this institution, the parent company has invested in dinars, right? The subsidiary has also raised 100,000 dinars of equity capital from an external source and has deposited the whole of the capital. So 2 million from parent, another 100,000 from another party. They have raised 2.1 million and deposited the whole capital with a bank in an overseas country whose currency is the dinar. Now, can you see what are they doing? They have formed up a company, like let's assume it's UK. In UK, they have formed a company, but the currency in which they are going to deal is dinars, and they have taken money from the parent company shares and also from another outsider, and all that money is invested in outside the country, in a Middle East country, obviously, in the currency, the dinar. The capital is to be invested in dinar denominated bonds. The subsidiary has a small number of staff, and its operating expenses, which are low, are incurred in dollars. So they do have a little staff. Their salaries are paid in dollars. The profits are under the control of Aspire because it's a fully owned subsidiary. No, not really fully owned. 2 million shares they are owning, 100,000 owned by some minority. So there's a kind of a 5% kind of a thing that is outsiders are holding. But the profits are under the control, surely, because it becomes a subsidiary. It becomes a 95% owned subsidiary. So they are controlling. The profits are under the control of Aspire. Any income from the investment is either passed on to Aspire in the form of a dividend or reinvested under instructions from Aspire. So you can say the dividend policy is under the control of the parent, and obviously it becomes a subsidiary. They decide whether to pay a dividend or whether it should be reinvested under their instruction. So the 100,000 small shareholder has no say. The subsidiary does not make any decisions as to where to place the investment. So subsidiary absolutely has nothing to decide, everything decided by the parent company. Aspire would like to advise on how to determine the functional currency of the subsidiary. I want you to understand the word, but they have used very clearly, how to determine. Because I think the answer is very, very clear. Answer looks very clear, but one word answer won't help. The question is how to determine the functional currency. So you have to talk about the IAS 21 and talk about little about how to determine the functional currency.
Okay, yeah, because there's lots of different things in the main funding is received in dinars.
Yeah. Main funding is received in, yes, correct, exactly.
Although the parent company clearly controls the business, and their currency is not dinars, it's dollars. They're making all the decisions. There's only a small amount of operating expenses in dollars.
Correct.
So that's...
Yes.
It's... The emphasis is on the capital in this section.
Yeah. Yes.
The question, because Aspire is it looks well, yeah, because Aspire is controlling all the decisions. It's not straightforward, although it looks like it is. But and their presentation is obviously dollars. Aspire's presentation and functional currency is dollars. Now the question doesn't ask about the presentation anyway.
No, they're not asking. That's it. They're asking about how to determine the functional currency of the subsidiary. Correct. Very good.
So the under IAS 21, we go back to what influences the main trade. And also the competitive forces and regulations.
Correct.
Because it's only a small amount, the currency that influences labour and materials isn't really relevant because it's only a small amount.
Very small amount, right.
Funding activities appears to be the main consideration. It receives its receipts in dinars as well, which is obviously a consideration under IAS 21. but it is controlled completely by the parent company, which raises the question. Because they have no decision-making, power themselves. It's completely the parent company's decision how the funding, what currency they receive the funding in. So from that point of view, that's then almost changing. Should it be in dollars?
Yeah, I think it's a good argument you brought it up. So if I were to start, I would have definitely said the relevant the standard to determine the functional currency is the IAS 21. So it primarily provides some guidelines or the indicators to determine the functional currency. Number one, the currency which mainly influences sale price for goods and services. Number two, the currency of the country whose competitive forces and regulations mainly determine the sale price of goods and services. Number three, the currency which mainly influences labor, material, other cost of providing goods and services. Then we have certain secondary indicators which will give additional evidence of entity's functional currency, the autonomy of a foreign operation from the reporting entity, the level of transactions between the two, whether the foreign operation generates sufficient cash flows to meet its cash needs, and whether its cash flows directly affect those of the reporting entity. So these are 1, 2, 3, first of all, the primary indicators. Then I indicated 4 secondary indicators. So whenever the functional currency is not obvious, as in our case, management should use the judgment to decide the functional currency, which should be something that is done faithfully, which represents the economic effects of the underlying transactions, events and conditions. So you can see here, we have both sides, share capital coming up in dinars, employee cost little coming up in these things, but the subsidiary is under total control of the parent.
Right? Yeah.
Sure, yes, come on. Yeah.
So the I mean, they're not asking for an answer, they're asking on advice. How would you advise them?
Advice how to determine. So this is what I was trying to talk. Now, having said the general thing, I must now go into the very specific what can be applied in our case. So in the case of Aspire, as far as we are concerned, the subsidiary does not make any decisions as to the investment of funds, right? And the consideration for currency which influences sales and costs is not relevant here, because there are no sales happening, no cost happening here, because they are taking money and investing in another foreign country, right? So no decisions are taken by the subsidiary. The sales and cost doesn't become relevant here. There is a little bit of cost incurred. So they say subsidy, a small number of which are paid in dollars. Yes, there's a little bit of cost incurred in dollars, but however they are not material, right, to decide on the functional currency. So we have to look for other factors. So we don't have sales, we don't have a big expenditure going out, and we don't have what we know is only that the decisions are made by the parent company. So we have to look at other factors. So basically the subsidiaries issued 2 million dinars to the parent company, right? And parent company currency is dollars, and also the proceeds have been invested in dinar denominated bonds at the request of parent company. subsidiary has also raised 100,000 dinars from external source, but this is very small compared to the equity issued to the parent. So even though it is same currency, we must mention that it is a very small amount. The reason is to show that we are controlling the company. The income from investment is either remitted to Aspire or reinvested on the instructions from Aspire. Now that's a very key word, because the retained profits are decided by the parent company, the Aspire. Subsidiary has minimum number of staff and they do not have any independent management. Basically, if you look at this subsidiary, what is it they are doing? They are basically a vehicle for the parent to invest in DINA-related investments. That is what they are doing, right? That's basically simply that is what they have done. So basically, they may have set up this entity to expose the DINA dollar transactions so that it will be reported in the other comprehensive income through the exchange translation. That is why. So therefore, most likely what we can say is the functional currency should be dollars.
Dollars, yeah, that's what I would say.
Exactly.
Although with ACCA, there's always, it is.
Because although they have not asked a very specific answer, after giving all the guidance, we must say, therefore, the most likely functional currency that would appear here should be dollars. Right? So that is what we should be looking at.
And I guess they set up the subsidiary to try and minimize the effects of the exchange difference.
Yeah, I think that is what they had done, because basically any gains or losses will be in the parent company, it will be reflected in the OCI part of it.
Yeah.
Right? Under IAS 21, it will be reflected in the OCI part of it. That is what they have done. And because basically the finance and operation and retentions are all done in at the influence of the parent company. So therefore, the investment of funds could have been carried out directly, and therefore it should be the functional currency should be that is of the subsidiary.
Yeah. So if the subsidiary, the creation of subsidiary, if at the subsidiary they had decision making.
Yeah, then of course the answer would have been totally different.
Yeah. So that is the changing. That's really the key on this one.
That's the key, because if they have the decisions to make, then the functional currency would have been the dinars.
And if the equity was the other way round, so it was only a small amount from the parent and the 2 million came from an outside external source, but they still didn't have the decision-making power, would that sway it or not?
The decision-making power we still carry in their favor.
Yeah.
In their favor, because decision-making is a very, very important one, because it all they only decide how much to retain, how much to pay dividends out. That's a key factor in deciding the functional currency.
Yeah, because they're the two main points in this question, aren't they? The funding of the 2 million dinars and the decision making.
Exactly. I think those are the two key questions. So we had to weigh in favor of the decision making, because there are no sales happening, no cost happening. Even though there are expenses in dollars, they are not material, so that may not be a factor for us to decide. Why we decided in favor of the functional currency being dollars is purely, I think, the autonomy. That's what we decided. On the other hand, if the DINA represents the currency in which the economic activities are happening, then the functional currency would have been the dinars.
Yeah.
Okay. If the economic, but we can see they are taken the money, they are going to invest in an elsewhere. So the operations are not happening in this case in the dinars in the parent country. So that is what happening. So you can see it's simple but tricky because you have to first go and explain the IAS 21, the criteria, and then just put up your guidance to them just to advise this is the way for us to determine the functional currency. And in my way, the functional currency would appear to be dollars.
Yeah. And what is that? That's probably about a 10-minute question.
Yeah, it's about 10-minute question. Yeah, that's right. Yes. Say 12 minutes, you could have easily taken on that one. Probably about 6 points should have been all right.
Yeah, because that's the thing, not to spend too much time on a small question like that, because
six points on a bullet point should have been all right.
Yeah, okay.
So let's look at the second part of that question. Aspire has a foreign branch which has now we have to remember all the time with the company is Aspire. Company Aspire means their functional currency is dollars. So that now it is 100% confirmed. Foreign branch with the same functional currency as Aspire. The branch taxable profits are determined in dinars. So maybe the bank that they have invested, whatever it is, the bank, the branch, the profits are determined in dinars. In other words, the presentation currency for the branch is dinars. On 1st May 2013, the branch acquired a property for $6 million. The property had an expected useful life of 12 years with a 0 residual value. Asset is written off for tax purposes over 8 years. So the accounting, it's getting written off over 12 years. Asset is written off for tax purposes over 8 years. Tax rate in Aspire's jurisdiction is 30. In the branch jurisdiction is 20%. Foreign branch uses the cost model for valuing its property and measures the tax base at the exchange rate at the reporting date. Aspire would like an explanation, including a calculation, as to why a deferred tax charge relating to asset arises in the group financial statements for the year ended 30th April 2014 and the impact of it if the tax paid had been translated at historical rate. So you remember how the deferred tax arises? Deferred tax arises due to temporary tax differences due to timing differences between the accounting base and the tax base.
Yeah.
That is what the deferred tax arises. How it happens is it's a temporary tax differences, time differences due to the timing differences between the tax base and the accounting base. So here the foreign branch taxes are determined in a foreign currency. Any changes in exchange rate may give rise to temporary differences, right? Because we will be converting at different rates here, IAS 21, because our asset being a non-monetary asset, we will convert it at the original historical rate. But our tax expenditure and liability being monetary liabilities, we will be converting at the closing rate. So there can be differences arising, and this difference can, because of the translational differences for non-monetary assets at historical rates and at the reporting date, there will be a kind of a deferred tax arising from that one. Right? So this is the resulting deferred tax we know should be credited or debited to the P&L. So now we need to do a little bit of calculation here. So they've given us the exchange rates here at lower. This was another bit of a nasty thing what we have to see in this paper. Even though it is applicable to the second section, that the exchange rates are given at the bottom, right, at the bottom of the question. So if you read only the second part, you might wonder what are the exchange rates I'm going to use it for calculation. So it's good to go to the bottom and see whether they are given, because this is a typical, again, a kind of an exam trap which you can fall into. You don't have too much of time to search for these things. So, but you must remember, this is how they give it in the exam. So we are given the first mate. So if I was you, I will write in my working paper, because I don't want to go to the question paper all the time. I will write the three rates. First May 2013, 5. 30th April 2014, 6. Average rate 5.6. I don't want to go up and down on the paper. Right, okay. So now let's look at how are we going to convert it. So when they acquired the property on 1st May 2013 for 6 million dinars, what is the entry you will put? On your accounting base, you will put cost of 6,000 dinars and you will convert it at the rate of 5, because that is the rate on the day that we bought, and it will appear at 1,200. 6,000 divided by 5, it will appear at 1,200. 1,200. Depreciation, it will get depreciated over a period of 12 years. So depreciation on dinars will be 500. So cost is 6,000. Cost is 6,000. Then cost is 6,000. It is 1,000. So then, cost is 6,000 divided by 5 is 1,200. Then we have depreciation over a period of 12 years of 500. That at 5 will be 100. So we'll have 1,100. The figure that will appear in the non-monetary asset, 1,100. Right? The figure that will appear in the non-monetary will be 1,100. What about the tax base? Tax base, 6,000. Right?
Yeah, it's written off over 8 years, not 12 years for tax purposes.
For tax purposes, the rate is going to be 8 years. 8 years. For accounting, 12 years. For tax purposes, 8 years. So, tax purposes will be 6,000 divided by 8, 750. 5,250. That you will convert at the closing rate, because it's a monetary liability. So you will take it the 5,250 at the closing rate, which is going to be 6. 5,250 divided by 6 is 875. So this is how we have a deferred tax element coming up. What is the deferred tax? The temporary difference is 1,100 minus 875, 225.
I'm not getting 80. Oh, I see. Okay, so 6,750 is the
6,000 minus 755, 250.
Yeah, so 750 is then
6,000 divided by 8. 6,000 divided by 8.
Yeah, so I've got 750. And then how did you get from the 750 to 875?
Now 750, 6,000 divided by 750 is, say, minus is 5,250. That the exchange rate will be the closing rate, which is 6. The closing exchange rate is 6. Because being a non-monetary asset, non-monetary liability, you will convert that at 6. 5,250 divided by 6.
Yeah, that's 875.
875. So the temporary tax difference is the asset base will show 1100 because the asset is converted at the spot non-monetary asset. The tax base we go on the basis because it's to determine the liability. Therefore we go by the closing rate, and therefore now we have 1100 minus 875. 225 is our temporary tax differences. Now the question is, how much is deferred tax? We take the temporary difference and we multiply by the tax rate, isn't it? Temporary tax difference, we multiply by the tax rate. Now my question is, what is the tax rate you will use?
Okay.
Whether will you use the 20% or will you use the 30%?
You'd use the 30%. Sorry, hang on. No, the 20%.
20%, exactly. 20%. 20% because it's the subsidiary company, tax-paying companies, tax rate should be used because we are working on the liability for the tax-paying company, not the parent company. So we must take 225 at the rate of 20%. 45 we have to charge it to the P&L because our asset base is more, tax base is less, and therefore it's a charge to the P&L of $45.
Yeah, I haven't got 225. I've got 325. There must be something wrong in
1100 minus 875. Did you deduct 1200 minus 875?
Minus 875.
1100 minus 875. Did you take 1200 or 1100?
225. Okay, yeah, I can see that now. Yeah.
Because 1200 is the original cost, but after 1 year's depreciation, it will be 1100. Right?
Yeah.
So 1100 minus 875, 225 is the temporary tax differences. At the rate of 20%, it is 45. So the first part of the question what they're asking is, why deferred tax arises? So deferred tax arises because of the exchange rate differences in the conversion. Being the asset, it will be converted at the historical rate, but the tax paying thing may be converted at the closing rate because that's the appropriate rate to determine the liability. And when you take that way, there is a difference of arising, and that difference is 225, and that difference into the tax rate of the subsidiary company will be 45. And then there's a little bit, a slight thing, another thing they're asking, impact of the financial statements if the tax base had been translated at the historical rate. Now we converted at the closing rate.
Right.
At the closing rate. So now they are asking, okay, if they are converted at the historical rate, what is the position? So we have 5,250,000. And then if we are taken at the rate of 5, it will be appearing at how much? 5,250,000 divided by 5, it will be 1.05 million.
Yeah, 1.05
million. Right? Originally it was 1,100,000.
Yeah.
Originally it was 1 million. So there's a temporary difference of 50.
Yeah.
At the rate of 20, it will be 10. You can see that's not a right way to do, but that's what the examiners asked us, is the impact if the tax had been translated at the historical rate.
Yeah. And is this an exam question, this one?
These are the June 2014 I'm doing, yes.
Oh, June. Oh, okay.
Yeah. June 2014 paper I'm doing now with you. Last question also we did the June 2014. I'm continuing the June 2014 paper.
Okay.
So you can see these are the same presentation I have taken up, and you can see the way they present because exchange rates are given at the bottom of the question, and also they are asking us the last part was a nasty one, and the impact if the base had been translated as the historical way.
Yeah, and it's only 6 marks as well.
6 marks, yeah.
10 minutes.
So, yeah, so you 9 minutes, 10 minutes most likely. So you have to take again couple of points and do it. But I didn't find too much of terrors in that question, because what I saw was if you can frame the picture, if you know the IS-21, you should be able to work out the second part much more fast even than the first part.
Yeah.
Because the only thing what you have to say is tax differences arises because of the conversion. Asset is converted to be a non-monetary asset. The tax liability to be determined is concerned as a monetary liability, and therefore it is converted at the closing rate, and therefore deferred tax arises. Okay.
Yeah.
The third part now. So on 1st May 2013, Aspire purchased 70% of a multinational group whose functional currency was the dinar. The purchase consideration was 200 million. At acquisition, the net assets were 1,000 million. Fair value was 1,100 million. And the fair value of non-controlling interest was 250 million. Aspire uses the full goodwill method. Wishes to know how to deal with goodwill arising on the above acquisition in the group financial statements for the year ended 30th April 2014. So we acquired, that's a simple one.
Yeah, yeah, that's a spin-in goodwill, and I haven't seen that in a question before. A foreign currency on, yeah.
Yeah. So normally in a foreign subsidiary conversion, there are two conversions. The goodwill you need to work out. Goodwill is considered asset, right? Goodwill is considered asset, and therefore goodwill will be retranslated every year at the end of the closing period. This is one exceptional situation where the goodwill can go up. Yesterday I told you goodwill will never go up, no? Right? Goodwill will always get impaired, but goodwill can never go up. But one exceptional circumstances where the goodwill can go up, because goodwill is considered asset, asset will be retranslated in a foreign transaction, in a foreign operation. You remember we were isolated transaction, non-monetary assets we convert, non-monetary assets we don't convert, monetary assets we convert. But in a foreign transaction, foreign subsidiary, all assets and liabilities are converted.
Right.
Right. So here we will look at hopefully if I can get a foreign subsidiary, we will look at that one, because I don't think ACC examiner has tested on a foreign subsidiary consolidation for some time. So we will look at one of those questions also soon. Anyway, having said that one, so here what we do is, first of all, let's work out the goodwill on the acquisition based on the dinars.
Yes, can you convert it?
Yeah, can you work out the goodwill based on dinars?
Yeah.
You only have to convert the consideration 200 million into dinars, and then convert and then see the goodwill. So the consideration will be 200 into 5,000.
Not in to 6. Restating it year end. No.
Before that, we have to calculate the goodwill on the day of acquisition.
Sorry.
We acquired it on 1st May 2013. No. So we must calculate the goodwill on the day of acquisition. First of all, starting point is that.
Yeah, I probably would have made a mistake there and done it by 6.
No, we will do it later. But first of all, convert it at the starting rate and do it. First, look at the goodwill asset on the day of acquisition.
Yeah, once the goodwill's worked out, then it's converted.
That's correct. First calculate the goodwill in the foreign currency. So the consideration is 1,000 million.
So that's
then
40.
NCI was 250. NCI was 250, so 1000 plus 250. Then we know the value of net assets is 1000. Net assets at the acquisition was 1000. So we see a goodwill of 250 million in foreign currency. Thousand was the consideration. 5 into 2000, yes, consideration was 5 into 2000. Then there was the non-controlling interest of 200, 1250. The net assets were $1,000 million. So the goodwill on the date of acquisition is 250 million. Is it correct?
Yeah.
Goodwill on the day of conversion is 250 million. That goodwill, convert it at the rate of 5. That goodwill, convert it at the rate of 5. How much is that? $50.
Yeah, 50.
Yeah, 50 million. $50. Yes, $50. $50 million. Okay. 1000 was the consideration. What we paid. 250 was the NCI. 1250. The value of assets was 1000. So 250 million was the goodwill on acquisition in the foreign currency. Converted, it is 50 million. Now,
yeah, it's quite confusing because some of these are in dinars and some of them are in dollars.
Yeah, that's correct. So we have to. So we are either we can do either way. We must convert everything to dollars, or we must convert everything into dinars.
Yeah.
One currency we have to calculate everything because the consideration came up in dollars. The purchase consideration came up in 200 million came up in dollars, and the other things were in the other currency.
Yeah.
So we have now got our goodwill at the thing at that amount. Now we have to see what is the goodwill at the end of the period. Now we have the same goodwill, no impairment, right? No impairment, the goodwill is 250. Now we have to calculate the goodwill at the closing rate at 6. 50, the same goodwill, we will divide it by 6.
Yes, and that's 41.7.
Yeah, 41.7 something, 250 divided by 6. So that's the goodwill when we convert it. 41.7 is the goodwill that what we converting. So that amount, that difference what we have is something, it is, we don't show it as a kind of a loss because it's a translation adjustment, and that we put it to equity.
So where would we put it?
That will go to the other comprehensive income.
Okay.
It will go to the other comprehensive income as a chart to the P&L, and will be shown under other components of equity.
Okay.
Any exchange difference are recognized in the other comprehensive income and accumulated and the other components of equity. So this is what we do here. Right? So this is the way for the goodwill treatment. Whenever we have a goodwill of a subsidiary foreign, first calculate it in the foreign currency, right? Take the goodwill and calculate it in the foreign currency. So the net assets at fair value 1000 and the consideration given was 200, all that kind of a thing. We can calculate it and calculate the goodwill. And having calculated the entire goodwill on that basis, you can calculate the difference, and that difference should be treated in the other components of equity. There's another component, but that they have not asked us and they have not given us information. They say we should know how to deal with goodwill. But you remember in IAS 21, it's not only the goodwill we have to deal with the retranslation of net assets. Any gain or losses arising, that also should be treated in the other components of it. That we cannot calculate here. They are not given any details. But generally, otherwise, we will have the closing balance sheet. We have to convert all the assets, remove the profit. Profit we will be taking up at average rate. So it's a bit of a complicated one. But the net assets at the beginning of the year, net assets at the closing year, we will convert it at the closing rate, and any gains or loss arising, that also will be shown on the other components of it. But that part is not given in this paper. This question, they have asked only us to say how to deal with goodwill arising on above acquisition. Right?
Okay.
So that's basically how you will do that one. Have another little bit fiction. Took a foreign currency loan of 5 million at a fixed interest rate on 1st May 2013. Interest is paid at the end of each year. Loan will be repaid after 2 years on 30th of April. Interest rate is the current market for similar 2-year fixed rates. Aspire requires us advice how to account for the loan and interest in the financial statements. So here it's not a subsidiary or anything. This is what we call a isolated transaction or a transaction.
Yes.
So what we do is, as we take the loan of 5 million, right? Because we are taking a loan of 5 million because our currency is US dollars. So we will convert it on 1st May 2013, taking the rate 5, debit cash with $1,000, credit the loan with $1,000, correct?
Yeah.
That's the first entry you will put. Credit loan with $1,000. Now, at the end of the year, we had to charge interest to the P&L. 5 million dinars, 8%. That is 400,000. So 400,000 is an expenditure. So expenditure we always convert it at the average rate. Average rate, right? So we will debit P&L interest 400,000. We will take the 5.6 rate and convert it. So 5.6 400,000 is 71,429. Credit liability 71,429. Okay.
Yeah.
That's the interest, the 400,000 converted at the average. Expenses, income and expenses are always converted at the average. Now you have to pay. When you are paying, you will pay at the closing rate. So the same 400,000, you have to convert it at the rate of 6, the closing rate, and see how much you are going to pay. So it is 66,666. So your credit cash, debit loan payable, 66,666, credit cash 66,666, right? So now we have an exchange gain arising because our liability, interest payable liability was shown as 71,429, but we paid only 66,666. So 71,429 minus 66,666, that is how much? 7,463 will be a gain arising, and that will go to the straight away to the P&L. That's a settled transaction. So the 7,463 we will show it under P&L as a gain on exchange. But that's not all. That's not all. Our liability which was shown as 1 million at the beginning of the year. Now we have to reconvert it because it's been a financial liability. It's a monetary liability. We need to convert that 1 million again at the rate of 6 closing. So when we convert the 1 million at the closing rate, it will come to 833,333. Originally we showed it at 1 million. Now the new liability is 833,333. Gain or a loss? Gain or a loss? Original liability was 1 million. Now it is 833,333. Gain or a loss? Liability getting reduced. That's a gain.
The gain.
That's a gain.
Yeah.
That difference of 167, 166 something, right? 166,667 should be also credited to the P&L. Any liability reducing, it's a gain that should be credited to the P&L. So the total gain to the P&L will be 166,667 plus 7,463. Both will be credited to the P&L. So those, the last two parts you would have seen, if we have actually the first part was the difficult one. The second, third and fourth, if we knew the stuff basically, IAS 21, we could have done it much more faster. Calculations were enough, but could have been done. So what I would again look at is for you to do these questions again and again. Look at the recording and do the questions again and again so that you will, get practiced into, because ACCA, one thing is that questions are very standard. One year to the other, it's almost the same kind of a thing, little changes here and there, but not so big changes. So,
yeah, I suppose the main change is whether with question one, is it going to be a P&L? Is it going to be
cash flow or a SOP?
Cash. Yeah.
And the other questions, if it's a foreign exchange question, almost this kind of a question will come. About 3-4 items, they will give one a foreign loan, one a foreign transaction, one a subsidiary, that kind of a thing. So when you do a couple of questions, so you have the BPP question book, I think I sent it to you, the revision kit.
Yes.
Try to look at many questions from that one also and try to work through, see whether you can get the answers. If you are finding difficult to get the answers, tell me the number, then we can work together.
Yes, okay, yeah, because I did look at some questions yesterday, and I did struggle with some of them where I couldn't, there was a couple of calculations I just couldn't work out where the figures had come from. You know, you have good and bad study days, don't you? Some days you do really well and other days you don't.
I understand, because sometimes, even for us, sometimes the brain won't work so well. So sometimes after a little relaxation, when you come, it comes up again. So, don't worry when the things are not coming up, don't worry about it too much. So we will, tomorrow, anything specific you want to do?
Well, what I'll do today, I'm going to look at the question that you sent me, so I'll send that back to you, hopefully today.
Okay.
So tomorrow, the only last thing then on IAS 21 is the one thing which to remember is land is treated differently, isn't it?
IAS 21?
Yeah. If a question comes up with land,
the IAS 21 is all about the foreign exchange.
Okay, so if a question came up to do with land, would that not fall under if there was a
basically you have to decide whether it's a monetary asset or a non-monetary asset. That's it.
Oh, okay. Yeah, so if it's non-monetary, okay.
Land becomes relevant in the IAS 16 because land is not depreciated. That becomes relevant in that one.
Okay.
IAS 17, sometimes when you have land and buildings together on the leasing, you may have a separate treatment for the land.
Yeah. Okay.
Right.
So maybe tomorrow, could we do another cash flow question?
Yeah. Another question like this or what?
On consolidated cash flows.
Okay, sure. Right, yeah, sure. I'll try to pick up another question and do it on the cash flow tomorrow. Yeah. Sure. Okay.
Or if not a position of or a balance sheet.
Okay. Sure,
if I look at P&L today, and cash flow and another balance sheet question.
Okay, sure. I'll try to pick up a question for tomorrow for you. Yes, sure.
Okay. All right. Thank you.
So I'll see you tomorrow again, Fiona. Take care.
Okay.
Bye.
Thanks,
Bye.
Fiona.
Bye. Bye.